get it over to you. I'm going to go through as much information as I can in about the next 35 to 40 minutes. So, we've been talking about for probably the last month how the market's changed a little bit, and I believe that to be absolutely true. I'm going to talk about that throughout this presentation. Certainly, specialized REO groups. What a specialized REO group is, if you don't know what that is, it's a name that was given to companies who kind of popped up when the foreclosure nightmare occurred back in 2008, and they were companies that went out and bought real estate, fixed them up, put in a tenant, and then sold them to investors. And sort of the value add, or what the thing that they brought to the party, was that they were organized companies that had contacts in certain markets, were able to identify certain opportunities, and then provide what the buzzword became, which was turnkey, a turnkey product, which was, a home that was rented, rehabbed, and cash flowing. And so those companies brought value to the table. And really for the last 5 years, there's been a number of these companies that have popped up all across the country. These are just some of the ones that I've done webinars with or for. People will contact me and say, I've got a fairly large network of people that have been following this sort of educational webinar event for the last number of years. Call up and say, we'd love to do a webinar with you. We've got a certain product or a certain service that we provide, and so could we do a webinar with you? We'll do some joint invitations. And so I've been doing that really since 2009. And these are just some of the groups that I've done webinars with. Summit Assets Group based up in San Francisco. Many of you know our REO reseller. Virtuoso Capital is a company that sees investing in real estate through the eyes of financial planners that can help you, sort of navigate those waters of, your retirement portfolio, your investment portfolio as a whole. And so we've done a number with them. We've done a bunch with AccuPlan, UDirect IRA, Entrust. We've done webinars with groups that have, managed people's 401k or self-directed IRA. Actually, if you Google buying real estate through your 401k plan or your self-directed IRA, all kinds of company names will pop up. Most of those groups will tell you that, investing in real estate is a powerful way to rebuild a retirement account or a 401k or what have you. And so we've done a lot of webinars with those groups. UDirect IRA, I mentioned them. I've been a guest twice on the Wall Street Journal radio network show called Real Estate 360. I was a guest there twice. And really, what I was talking about really was, and why they asked me to be on, was because I was dealing with a lot of institutional buyers. And this was about the time when, the hedge fund guys became very obvious that they were aggressive in the market and buying, foreclosed real estate as an investment. So they asked me, will you come on and talk about, sort of what their strategies are, what your experience has been working with these sort of larger institutional buyers. So I was able to do that a couple of times. And I get asked this question a lot. I'm just going to focus on this for the next couple of slides here. But the housing market's rebounded. I'm sure this is not foreign to anyone on this call. You know that the market has come back. We've seen a solid 12% increase from 2012 to 2013. So we've seen a nice little rebound in the market. So lots of people say, did I miss the market? Did I miss the opportunity? Have prices gone up so high? This cartoon kind of frames it. I know prices were high now, but man, when I got into it, it was a buyer's market. When I was house, it's still a buyer's market. I'm going to talk about that. And people, they wonder, is this a good time to invest? I frankly think 2014 is going to be the best year for investment real estate. There's a lot of reasons I say that. So what I want to kind of focus on is for a few slides, just, so where's the market going? I've spent a lot of time in January and February. I see a lot of names in here that attend these regularly. We talked about in January, February, sort of tying up what we saw in 2013, what we expect to see in 2014. So let's just kind of focus in on now what we know for certain. As we walk into 2014, what do we know to be about this market? Well, the first thing that we know is the institutional buyers, the hedge fund guys, they're still buying. They're still buying like crazy. I work with a lot of these groups. I do work with Blackstone. I have talked to somebody with Warren Buffett's group, which is Berkshire Hathaway Home Services. I've talked to one of their buyers rep. Property Direct is my biggest client. I'm in a group called Havenbrook. They make offers on properties that we put out there pretty much daily. So I work with these guys. So I get to know a lot about what their strategy is. You talk to them, and each one will give you a slight variation of the same story. Yeah, it's a commodity. We're buying at great prices. It's great cash flow. This is the lowest the market's been in years. It's going to come back. You hear that stuff, but you also hear things like, your portfolio can't get wiped out in real estate. and real estate is the safest investment for our clients. I love the cartoon, the hedge fund guy, specializing in highly complex derivatives and exotic financial instruments for the discriminating investor. He says, buy gold. That's the buy real estate. That's the simplest thing you can invest in, but it's also considered to be the best investment in America today. And so why do they buy? Well, it's just for that very reason. They consider it to be the best investment in America today. And if you talk to these guys, and I have many times, sometimes many times a day, this is what they'll tell you. They'll just basically say, yeah, this is where we see the best place to invest money at. It's not in some tech stock. It's not in the stock market or mutual funds. It's not in the Iraqi dinar. It's not in that stuff. It's in real estate. And so they see the opportunity. So you got a lot of large groups that are in the that kind of joined the party a number of years ago. And I really do believe it started when Warren Buffett was interviewed on CNBC. This was in like April of 2012 or something. Yeah, April 2012, somewhere in there. But they asked him. They said, "Is investing in real estate a good idea?" And he said, "Well, yeah, it's the best investment you can make, and I'd buy millions of single-family homes if I were what do you say? I'd buy millions of single-family homes if I were handy." And what he was saying is that I'm not handy. I'm not a fixer-upper kind of guy. I'm not the guy that's going to go down to the courthouse steps and buy the property. In other words, what he was saying was, if I had infrastructure around me, I would buy millions of them. So, of course, Warren Buffett being Warren Buffett, in October of 2012, he purchased Prudential Real Estate. And he's probably the most bullish guy in the market today in terms of, promoting the value of buying real estate as an investment. I seriously could do a webinar for an hour on just Warren Buffett quotes and what he thinks about the real estate market. But the main thing that he says is, if you Google what some of his quotes, is that he consistently says the market's rebounded. Yep, that's true, but it's not anywhere near the previous peak. It's far from recovered. It's got a long way to go. Blackstone, they are the largest owner of single-family homes in America. They raised the largest opportunistic fund ever raised in the United States, $13 billion. They've got 31,000 homes now in 13 markets across the United States. They are incredibly aggressive. They are terrible to deal with. I will attest to that. But they are aggressive, and they are a buyer, and they conduct themselves like a corporate entity that has, $13 billion to spend. John Paulson is the guy, if you didn't know this, he's the guy that accurately predicted that the housing market was going to crash back in, I think it was 2007. He was recently quoted as saying, "I don't think it's too late to get involved. I still think buying a home is the best investment you can make, and affordability is still at an all-time high." I believe all those quotes are sort of true. And so what are some of the reasons why they see this market as being viable to invest those kinds of dollars? By the way, in 2013, it was $9 billion that these guys spent buying residential real estate. Well, these are some of the reasons. First of all, yeah, you're buying at historic lows. That's clearly the case. The market has come up. No question about that. I've seen it myself on the wholesale side. Prices have absolutely come up. The number of foreclosures coming onto the market has clearly gone down. I won't bore you with those statistics, but those are all truisms. But still, you're buying at historically low numbers. I mean, it's still a great market to buy in, and probably will be for quite some time. Number two, it's an appreciating market. Now, some pockets are good, and some pockets aren't so good. I'm going to show you all a report today that I just read for the first time last night. I haven't finished reading it yet. It's a 100-page report on the market. But it's an appreciating market. If you're buying the right place, you know statistically that you're in the right place, the market's going to go up, and you get a good ROI. Now, the difference between the two, for those that don't know it, a high ROI, when I say ROI, I'm talking about your year-to-year cash-on-cash return on your investment. You invest $50,000. What's your rate of return? If you left it in the bank, you'd get 1.5%. What if you put it into real estate? Or if it was in a mutual fund, what would you be earning on that money? Well, what if you put it into real estate? What kind of ROI would you get, yearly ROI? Appreciation is in addition to ROI. So it's the market going up as years go by. As time go by, the market, you bought it at 50, well, now it's worth 60. It's gone up. You've had an appreciating asset. Ideally, you want to look for both, and I'll talk more about that later. Number four, tax benefits. I'm not a tax consultant. I can't tell you about tax benefits. I'm not qualified to do that. But I would tell you that if you're going to buy secondary real estate, I very much would encourage you to look at the tax benefits. I have seen what they are, by the way, and frankly, a lot of them I wasn't even aware of. So there's some good benefits from a tax perspective. Anything you read about the rental market will tell you that rents are going to continue to climb. And so you buy an asset today, and you know for some certainty that as years go by, your ROI is going to continue to go up because the rent's going to go up. So your cash flowing asset, which in this case is a home that you own in your name, the cash flow from that property is going to continue to rise. Most all of these guys will tell you one of the key things is the stability of the market. They know that they could wake up tomorrow if they're invested in the stock market and something could occur and your values can go way down quickly. They also know that in the real estate market, even if something goes wrong in the economy, and a good example is what we saw in November of last year, and I never like talking about politics, and I'm not going to now, but when the government shut itself down, the market did feel it. Most indicators will tell you anywhere from 2 to 5% the market slid during that period of time, simply because people got nervous, and they were concerned about their job, they were concerned about their Social Security check, they were concerned about a lot of things. And so the market was affected, but it wasn't affected like it was some sort of catastrophe. It had a little dip, the crime might right back up again, all is good. But the point is that the housing market is considered by high-level investors as being stable, where other markets are considered to be more volatile. So they find it to be safer. Creative exits. Any business, regardless of what you invest in, should have an exit strategy, right? Doesn't matter what you buy, you want to have an exit strategy. The good thing about the housing market right now is from anywhere from putting a for sale sign in the front yard to calling a hedge fund buyer or just saying, Charlie, will you feature my property on one of your webinars? You have all kinds, and it's not just, I'm not the only guy that does this, just there's all kinds of creative exits when you do want to get out. And then finally, again, these guys see real estate as a commodity. It's a hard asset. It's not a paper stock. It has value because it's a commodity. And so they see those things as the primary reasons why they're, now I will also tell you that they will also tell you scary stories about what they think could happen in the economy and could happen in this country if there was to be an unfortunate sort of an event. And they'll also tell you those sort of scary stories which say, if we own real estate and we've got people paying rent, we're going to get cash flow and the market will come back. Even if the market were to dip again, it will come back. And since we're buying so low, just the safety of that investment is extremely attractive to these folks. So we're going to talk about their strategy. Now, there's two different types of strategies, and it's very important that you understand them both. The first strategy is the strategy of how they acquire real estate. So what strategy do they employ to buying real estate? You know, when they determine they're going to buy in a certain market, you know, what is their strategy for acquisition? So let me describe that to you. I will get an email, and because they change their strategy about every 3 to 6 months, depending upon the group. And every market, by the way, their strategy is different. If you deal with Blackstone in LA and Blackstone in Atlanta, it's two different strategies, two different buying criteria. So you get an email, and it'll just simply say, here's our criteria. You need to have a 3-bedroom, 1-bath minimum. It's got to be built 1960 or newer. And by the way, the age of the home is market dependent. You can't say 1960 or newer and be buying in Atlanta because you have a lot of older homes there. You can say 1960 or newer if you're in Southern California, because we all know in Southern California, if a house is more than 30 years old, you got to tear it down and build a new one. But in other parts of the country, that's not the case. So the age dependency is based on the market. But they'll give you that criteria. You know, they'll say, you know, we need a 3.1, we need a 3.2, we've got to have at least a carport. We want these zip codes. We don't want those zip codes. Don't give us things in those zip codes because our analysts determine in those zip codes there are not enough owner-occupants to make that particular market there viable in terms of resale. So you know, some guy, some analyst in a room someplace does all this research on these markets, and they then conclude where the best places to buy are and what the best, you know, profile for that inventory is. And then you get their criteria. Now, we're going to talk about your criteria later on, but I would encourage you as a buyer, if you are a buyer or considering being a buyer, to develop a strategy. And if you need help with that, you know, I'd certainly be willing to talk to you about what that strategy could or should be. But you want to know your strategy. So the first thing is, what's their acquisition strategy? They identify the market, they identify the model, then they put it out to their associates and say, these are what we're looking for. If you can put us in contact with these people, you know, we'll pay you a small fee to introduce us. That's sort of how it works. Okay, the second strategy is, what do they do with it after they buy it? So now they've bought it, they've identified their model, they buy it. Now what do? I only know one group that does flips, and that's not to say you can't get a good flip. I had somebody call me after today's webinar at 10 o'clock and say, hey, you know, I'm really into flipping. And I said, I think flipping's awesome. Flipping's great. You can get some good flips out there. But what I'm saying is, the guys that are in this market, the most heavily invested people in this market, these guys are all doing buy and holds, all of them. And I'll just go through with Jonathan Gray. Jonathan Gray, by the way, being quoted here, is the CEO of Blackstone. Jonathan Gray became a billionaire with a B in 2013, according to the IRS, or excuse me, the Securities and Exchange Commission. He took out $220 million in bonus money alone last year. He says here that he believes the market will remain bullish for 2 to 4 more years. I agree with that, although I will tell you that I believe it's market dependent. I think some markets don't have 6 months in them, and I think other markets have more than 4 years in them. So I think that's market dependent. I think some markets are better than others. I'm going to show you a report in a couple of slides here that I just recently read that's going to frame that. I'll get to that in a few minutes. But I believe that to be true. Then he goes on to say that Blackstone's strategy is to isolate key markets for growth, renovate properties, and then rent them out. Now, draw your attention. Where he says key markets for growth, he's not talking about key markets where you can get lots of houses. When he's talking about growth, he's not talking about numbers of properties. He's talking about growth in terms of appreciation. Isolate key markets that are growing, not the markets that are flat. I live in Orange County, California. It's a great place to live. Lived here my whole life. My kids have been through the public school systems here. Got 4 kids in college, and this is a great place to live. But would I do an investment strategy here? No way. The market here is flat. There's the room for, you have greater chance of being a bubble here than chance for appreciation here. That's just Southern California. That's just Orange. Let's just call it the pocket of Orange County, California. But in other markets, many other markets across the country, it's the opposite. You can get a lot of appreciation. So what they're doing is they're looking for markets for growth. Renovate the properties, put less than 10% of those costs into it for the rehab, and then rent them out. And then the last thing he says is, we have a 94% occupancy rate. What does that say? It says the rental market is solid. And then finally, they're trying to build a long-term business, meaning they're not flipping. They're not in it to flip it. They're in it to hold it. Now, I get asked a lot of times, well, what does that mean, Charlie? You and I both know these guys aren't holding this long-term. What are they going to do with these properties at some point? Are they going to bundle them and sell them as securities on foreign markets like the mortgage companies did back in the mid-2000s? Maybe. Maybe that's their strategy. But essentially, for somebody, buying real estate is a long-term buy and hold. Let the market appreciate, take advantage of those tax benefits, take the ROI in a stable market, the safest place to have your money. These are all the reasons why these guys are sinking billions of dollars into this market. Okay, so what do we know? Just some quick news clips here. Bloomberg from February 6th, just a couple weeks ago. About 77% of investors with at least $1 million will buy real estate, according to New York-based investment bank's wealth management unit. Direct ownership of residential and commercial properties was the #1 alternative investment for 2014, with a third of millionaires surveyed saying they plan to buy this year. Going back to that slide, is it the right time to buy? I think it's the best time to buy. There's a lot of reasons for that. We'll talk more about that as we continue on through the webinar. But what that just essentially is saying is that people with a high level of success in this country recognize as part of their investment portfolio, they should have a percentage of that in real estate. It's a stable investment for their portfolio. Again, Bloomberg from February 6th again. Wealthy investors are turning to rebounding real estate market as fixed income yields remain historically low and equities surge. Buy low, sell high. It's just the old investment strategy. You can get in at great prices, and you're seeing equities continue to fly. So that's the kind of the way that they see it. Now, this is really interesting. This is from Credit.com. I had somebody, she might be on this webinar, so if you are, I love you. Tell me yesterday that I think I want to sell because I think the market's going to go down. Now, I'm going to get into some statistics as to why I don't think that's true at all. But this is what's really important to point out about that. Some people will say that. You can read some things today, and it's out there that'll say, oh, housing prices could go down in 2014 because interest rates are going to go up. There might be true the second part because interest rates will go up, but if you read what Credit.com reports here, 44% of all sales in 2013 were sold via cash. There was no loan recorded at the time of closing, which means it was paid for by cash. Now, what does that mean? It just means that the vast majority of people that are buying houses in America today are not owner-occupants, they're investors. That's who's buying the inventory. The inventory is being bought by Blackstone and Warren Buffett and John Paulson and by PD, which is Buy Direct. I didn't mention that. Buy Direct is a big hedge fund, the largest client that I have. Maybe I did mention them. We're going to talk about that because they buy direct. That's their name, Property Direct. They buy direct. We're going to talk about that, but that's what they do. These are the guys that are buying houses. So that was an increase of 34% increase from the same time in 2012 of people buying. So when people say, did I get it at the wrong time? I should have gotten it in 2009 when it was really the lowest. The smart investors have increased their activity in terms of acquiring properties in 2013, and we believe that's going to continue in 2012. For example, Prudential Real Estate. This is Warren Buffett's group again. They released their outlook for fourth quarter. They're indicating that consumers' perception of residential real estate is increasingly favorable, and that consumers are more committed to buying and selling homes in 2014 than they were during the previous year. So again, and there's reasons for this that we're going to get into as we get through this. I'm trying to paint a full picture here as to why we believe this is the way the market is going, and this is where the individual investor is heading. So how does the individual investor compete? I mean, that really becomes the million-dollar question. You've heard, 20 minutes of my presentation now, and I'm sure you're saying, yeah, okay, but I'm not a hedge fund, and I don't have $1 billion, and I don't know how to do what these guys do. Well, that's what we're going to talk about. So as an individual investor, how do you compete in this market? This market has really changed. That was the first slide I had. The game is changing. I believe the game is changing. I think the game has actually already changed. Just a lot of people didn't know it. I actually saw it sort of brewing about 6 months ago, and until it came to full fruition really in December and January, for me at least. And then the reality was there's a better way for the individual investor to do this. So how do you do it? First of all, number one, you got to buy below market value. You got to buy at less than what anybody else can buy it for, which means you can't buy it on market. If you're buying it on the MLS, you're not going to get the best deal. You got to buy it through sources that are on the ground, that understand the market, to get the best deals from the best sources, and then make them available to you direct with nobody in the middle. But you want to buy below market value. I'll give you some examples of that in a few slides. You want to buy direct from the selling party. That's where I believe the market's going now. I'll talk more about that as we continue through the slideshow. But I believe that is the absolute key, is for you, the individual investor, to buy just like the hedge fund guy, buy directly from the source. Nobody in the middle, nobody buying it and marking it up 20, 30%. Just you buy it directly from the selling party. Incredibly important, I believe, and that I believe is going to be the way this market is going to go, is going to trend from now until their inventory is no longer available. You want to look for both year-on-year ROI and appreciation. Now, why would you, as an individual investor, say, yeah, I want to get both. I want both high appreciation, a market that's at least 5 to 10% annually in appreciation, and I want to get at least 10 to 12% cash on cash on my money, year-on-year, cash on cash on my money. And the answer is simply this. You want to do that because you can. The opportunity is there for you to do that. The hedge fund guys can do that. There's no reason why you can't do that. So you want to look for both. You want to be able to get a good cash-on-cash return. You want to get good in a good market that's appreciating. Don't settle for one or the other. And just a quick example, I did a lot in the Atlanta market in 2012. Did a whole lot down there in 2012. I had one of the best, actually still my best wholesaler in the country is in Atlanta right now. If you want Atlanta inventory, I can get it for you. But here's the deal. It used to be in Atlanta, you were getting properties you could buy for $40,000, $50,000 that were worth twice that, and you had cap rates that were 12 to 15%. Today, you're going to buy at least at $60,000 to $70,000. You're going to probably have a little bit of money to put into the house, and your cap rate's going to probably be 6% or less. Now, is that market still appreciating? Yeah. Is it a great market to be in? Absolutely. It's considered to be one of the better real estate markets in the country, one of the more vibrant, growing economies in the United States. But you don't get both. You really only get appreciation. You're not going to get a whole lot of cash. And some people don't care about that. But from my view is, if a hedge fund guy is going into a market, you might consider following him there. And I can tell you that I've seen a number of hedge funds in the last 6 months leave Atlanta and go to other markets. Why? Because you know what I just got done saying. You get better deals in other parts of the country. This isn't about located at. Don't buy this as an emotional thing, as if you're going to live in it. You're not living in this property. You're buying it so that you can make a return on your investment on that property. Okay, number 5, have your infrastructure in place. Property management is key. I meant to have some slides in here today with some of the property management companies that I now refer out to people, because these are all state-of-the-art groups that provide excellent management on the ground. It is an enormously important piece, and I apologize for not putting some more information in here about it, but I can get that to you if you'd like to see it. But I only work with groups that come highly referenced. I only work with groups that do everything online, that are paperless, that you can go online and see what's going on with your property. There's a lot of things that make some groups better than other groups, but I didn't do that. I apologize. But management is absolutely the key, and we've identified great property management teams in each one of these markets. And then finally, understand your strategy. I talked about, what's the hedge fund guy's strategy? They know their strategy. They know how they're going to buy. Then they know what they're going to do after they buy it. You as a small investor should be doing the same thing, and I'll talk about this more in a few slides, but you should know your strategy. Are you in for a flip? Are you in for the long term? What is long term? Is it 3 years a long-term strategy for you? Are you 60 and do you want to cash out when you're 65 for retirement? So are you into it for a 5-year hold? Those things are important because those things help us help you find the right property for you based on that strategy. By the way, that's not to say that you can't change your strategy midstream. If you buy something tomorrow and in 6 months you have an event that would cause you to need to liquidate that property. You got to sell it. You need money for your kid's college or whatever. You can always do that, but you should still understand your strategy before you buy. You should understand what your long and short-term strategies and goals are. So I follow Ken Corsini's blogs. For those of you, there's a few professionals on the line I can see today. If you don't read Ken Corsini, I follow him quite a bit. He writes a lot of really good stuff about the real estate market. And I took this one off for this slideshow. And it wasn't so much what it said, because what it says is, what you'd expect, me to be saying today, and that is buy direct from a wholesaler. But it's the date. Look at the date of this. October of 2011, he was saying a great way to take advantage of this market is to find a wholesaler. Now, let me tell you what a wholesaler is, because I had somebody call me. This was last week after one of the webinars, and the lady said to me, but a wholesaler is just a realtor, right? Yeah, maybe. In some cases, yes. In some cases, no. Some of the best wholesalers I deal with are actually contractors. They are guys that have been in a market for typically this is what the wholesaler looks like. I'm going to give you a profile. He's someone that's been in a market for a while. He hasn't been there for 2 years. He didn't just move in there because it was a good market. He's been there. He knows the schools. He knows the streets. He knows the houses. He knows the values. He knows where the market's been. He knows where the market is going. He's someone that's in a market. He knows where to get the best deals. He knows where to get the best contractors. He knows where to get the best, deals with the banks. If he goes to the courthouse steps to buy a piece of property, he knows what he's buying because he knows the house. Those are the guys that you want to buy from. Now, these guys have always been around, but here's the rub. The reason why in October of 2011 you couldn't find a wholesaler is because nobody knew where to find them. The wholesalers were insulated by these specialized REO groups. Specialized REO group would go into a market. They would say, okay, we're in the Atlanta market. And they identified Johnny Hamilton, who's my wholesaler in Atlanta. And so Johnny is now the wholesaler for XYZ company, and he's finding them properties. And he's doing well. He's finding them properties, helping them rehab them, doing all these things. Now, this specialized REO company, they insulate their clients from that wholesaler, because if they go around them directly to the wholesaler, they're dealing direct with the wholesaler now, and that never happened. Now, the wholesaler wasn't going to cut out the specialized REO group because he's got a good thing going. They're buying 3-4 houses from him every week, so he's out there, he's just turning and burning, so he's doing well. So there was no way for the individual investor to marry up to that wholesaler. Well, when I talked about the market changing, that's what I was talking about, because really what's happened in the last 6 months is more and more I've been seeing the wholesalers with a desire to deal directly with the individual investors and not going through these third parties. And there's a lot of reasons for that I won't bore you with, but there are good reasons for that. And part of it is the obvious one, and that's when as the market does recover, margins get smaller and smaller. You're making less and less per deal because the market's going up. So in order for that end buyer to get a product that they want to buy, somebody's got to get cut out of that equation. So what we've seen happen is those specialized REO groups are now being challenged by those wholesalers that are recognizing the value in dealing directly with the individual investor. So then, how do you do that? You just create a marketplace, and that's what we've sort of done. This is just a wholesaler's marketplace. We've made arrangements with a number of different guys that we've worked with over the last number of years that are in certain markets, that understand what's going on in those markets, that have access to the best stuff, and I'll show you some examples here in a few minutes. So incomepropertyheadquarters.com is just a place where it's a marketplace. It's a place where you can go to see inventory that's made available directly from a wholesaler. Now, you won't get everything off the website. I'm not going to tell you you're going to go to the website and have all your questions answered, because you're not. You're going to have to contact us so we can give you the dossier of each particular property, but it's available. But for the purpose of putting up a website, it's got pictures of the homes, numbers, all that sort of stuff. But it's a place, whether you're a wholesaler or an individual seller trying to market a property, you get access and exposure to the greater market by going directly to that particular site. Now, this is out of order, so I'm going to skip one and go back to that slide in a second. I just got this yesterday. I got this yesterday at about 4 o'clock, and I was doing something with my kids, a church event. It was Ash Wednesday yesterday. So but I read a little bit of it, and so I read enough of it to know that this was a really powerful piece, and I started reading some more of it today. It's not short. It's actually about a 100-page document. It's written by a group called the Demand Institute. Demand Institute is a group out of New York City. They're a nonprofit. They do governmental work. They do research for the United States government. They do research for the private sector as well. And they wrote a very extensive piece a piece about the housing market, and believe me, it's detailed. I mean, detailed to the point of being boring, but it's great stuff. And if you're an investor or if you're an industry professional, contact me. I'll send you the link. I totally would encourage you to read it. I want to just highlight a couple things. First of all, it's called The Tale of 2,000 Cities, and it actually does research on 2,000 cities between 2012 and 2018. And what it does is it sort of talks about the sharp contrast between the successful and struggling communities and how that's reshaping America. And if you remember what I said about Jonathan Gray, when he said, we believe the market will remain bullish for 2 to 4 more years, and I've been saying this for a while, I said, well, I believe that, but I also believe it's market dependent. This is what this frames. It says you want to be in some places. You do. You don't want to be in other places. You don't. And that's what it talks about. And it does it, you know, it profiles 2,000 cities, so it's pretty aggressive. Now, for the purpose of the slideshow, I'm just pointing out a few things here. In terms of, they profiled from 2012 to 2015, and then appreciation from 2015 to 2018. So they go out actually all the way to 2018. But for this, I'm just going to give you the synopsis of it. Some of the markets that we're in, Memphis, Kansas City, Atlanta, Birmingham, look at what they're predicting those markets to appreciate by. Now, I'll tell you, in Southern California, where I'm at, I talked about that as well. There was only 2 places, I believe it was Bel Air and Long Beach, California, that had semi-aggressive projected growth forecasts from now to 2018. But in these markets here, 33%, 22%, 21%, 21%, this is sort of how the thing looks. Demand Institute, the evolution of the housing market. Gives you some by the way, it gives you 2 different charts. It gives you all 50 states. So you got all 50 states and how they fall in the category. And then it also gives you the top 100 cities, which is what I gave you on the next slide, which was, you know, these are in the top. Memphis, actually Memphis was number 1. And interestingly, I have Memphis inventory, and I didn't put it on the slideshow. I'll do that next week. But Memphis was actually number 1, considered to be the number 1 rebounding market between now and 2018. But these other markets aren't bad either, Kansas City, Atlanta, and there's a whole bunch of them. I'm just sort of profiling these for the moment. If you'd like a link to this article, I'd strongly encourage that you read it. We talked about Birmingham. This is one of the markets that we're going to talk about that here real quick, and then I'll be done and take some questions. This is CNN Money, the top 10 hottest housing markets for 2014. Birmingham rated number 8. They project a market gain there of 7.8%. They've done a lot of stuff in Birmingham, but anyway, CNN Money says the 8th best overall market in the country, and the 3rd fastest growing real estate market in the nation. New Wire says it's the 3rd best cash flow market in the country. I will tell you that the hedge fund guys are all over Birmingham at the moment. We had one just move in there. They're called Brookhaven. I don't mind telling you who they are. They're called Brookhaven Homes. I had 7 offers today on, well, I had 7 offers on 7 homes there, actually. I had 7 homes there that I thought fit their criteria, and they offered on all 7 of them. So they're very aggressive in that market. They've spent $1 billion revitalizing the downtown in Birmingham. Birmingham, believe it or not, is rated 3rd in the country for building personal net worth. What does that mean? Personal net worth, for those of you that have any finance background, it means disposable income. You got money to spend. You can go to the movies. You can go to the restaurants. You can go to the baseball game. You've got money to spend. That bodes great for housing. It's a great housing market. They've invested $1 billion in that state-of-the-art facility, which is right downtown. You can see the city right behind it. That is downtown area of Birmingham. They spend a lot of money down there. Okay, so I'm just going to run through some properties, and I'll take some questions. This is just going to give you some examples of some property that you can get. Now, remember I talked about if you get a cap rate of 10, I mean, there's some markets out there. You know, Phoenix is a market. Las Vegas is a market. I've already kind of bashed the Southern California market. I didn't bash. I was just kind of describing what's happening here. But, you know, if you get an 8 to 10% cap rate, you're doing pretty good. And there's nothing wrong with that. If you're in a good appreciating market and you're getting 8, 9, 10%, there's nothing wrong with that. You know, you're not going to get that in the bank. You're not going to get that in a CD. You know, the stock market's volatile. There's nothing wrong with 8, 9, 10%. So I'm not saying there's anything wrong with that number. But what I am saying is there's other markets we can do a lot better, which is why the larger institutional buyers flock to these markets. This is a $46,000 house. ePraisal says it's worth $77,000, so you're buying it at a good price. You're buying it direct from the owner. It's got a 14% cap rate on it, so you got a 14% cash flow. I was asked this question the last time, by the way. When I put up an ROI or a cap rate, that's net after expenses, insurance, taxes, property management, all that stuff. So these are net numbers I'm throwing out here. I do not calculate in maintenance. I don't calculate in vacancy. You can do that too. That'll affect it a little bit if you want to factor those numbers in. Some people do and some people don't. But those are net after expenses, which is taxes, insurance, property management fees. just to give you an idea. Now, this is in Kansas City, Missouri, and I know that does look like the house that landed on Dorothy in The Wizard of Oz. It does a little bit, doesn't it? But that's the Kansas City property, 29. I got 3 of these actually, and look at the workmanship these guys did. These guys are really top quality contractors that buy these houses down there. I got 3 of them that are just like this. Not identical, of course, but they're just like it. They're all priced around, $25,000 to $32,000. But the caps are high, 17%. ePraisal calls it it's worth $58,000, so it's way under market value. It's going to appreciate in value. Kansas City is one of the markets that's in the top 10 of markets to appreciate between now and 2018. The craftsmanship is beautiful. The rental values are pretty decent for little homes like this, but the values are great. And I put this up here because I always have people that inquire about a low cost of entry. They're looking for something. They don't have $50,000 or $75,000 or $100,000. And in some markets you can't buy for under $100,000. Or in some markets like Atlanta you can't buy for less than $80,000 or $70,000. So for people looking for a lower cost of entry, yeah, they're absolutely out there. We just need to know what you're looking for. This is a great property here, and if you could see the inside of this house is, I mean, I'm telling you, the contractor who did this, which is 3D Properties, the guys that did this, oh, and by the way, I don't mind giving out who these wholesalers are. I have relationships with all these folks. They know I'm profiling their property, so I don't have any issues with putting up there. The seller here is 3D Properties. They're a great group of guys down in Birmingham. They've been there for a long time. If you saw the inside of this house, it looks brand new. When I saw the scope of work on it, it is brand new inside. I'm talking about everything from the electrical to the plumbing, the carpet, the walls, the new paint, the cabinetry, the bathrooms, the kitchen. It's just a beautiful property. $47,000, $67,000 listed on ePraisal, and it's a 15% cap. So you got great cash flow on that. And yes, it did snow in Birmingham a couple weeks ago. Again, just taking you on a tour here. This is down in Macon, Georgia, another market that's going to continue to appreciate. Again, really low cost of entry. CoreLogic's got that at $50,000. This particular wholesaler, it's actually a man and woman team that buy down in that market. They're getting rid of these at $17,000 a house. The ROIs are stupid. They're 27%. I mean, I got 4 of these left down there. One's renting for $625, and they're selling that for $17,000. Now, as an example, I put this up here for one reason. A lot of people aren't going to want to go into Macon, Georgia. It's not the greatest neighborhood of all time. Now, some people will, obviously, for an investment strategy, but I did this for a reason. Here's the reason. A year ago, this type of property would get purchased by a specialized REO group and marked up. They probably marked it up to a good $27,000 to $35,000 and be sold. Now, what we're able to do is take this directly from the wholesaler, stick it on the Income Property HQ website. We'll sell it off the website for $17,000. End buyer gets a great deal, low cost of entry, great cap rate, great cash flow in a market that's going to appreciate, and you're not paying a middleman, so you're not paying the markup, because you would see a markup on something like that. Yeah, we do sell in bulk. I got asked that a lot, so I started putting this slide up there. If you're looking for bulk properties, you can buy them in bulk. You get better prices when you buy in bulk. I was just making. There was actually 8 in Macon. We sold 4, and there's 4 left. But the same type of thing, it's a $17,000 per house investment amount. The cash flow is huge. ROI is pretty huge, but you can buy in bulk. So, okay, 2 more slides, and I'll take some questions. First of all, I talked about criteria. Knowing your criteria is really important for a couple reasons. First of all, you should understand it as an investor, what you're trying to accomplish, because marrying that up with what's available will help you get the best deal for you. It's no different than the hedge fund guys do. We want to know what your criteria is. If you go to the website, there'll be a link there, and you'll be able to click on it, and you'll be able to type in your buying criteria. The other reason I did this was, and I've told this story, so for those of you who've been on here, I'm going to bore you for the next 30 seconds, but it is true. Over the last couple of years, I would have people call me up, and they would say, hey, Charlie, I saw your webinar. I really like it, but I'm really looking for property in Philadelphia. Do you have any property in Philadelphia? And I'd say, man, I really don't, but if I come across something, I'll let you know. And some time will go by, and then somebody will call me up and say, I've got 4 single-family homes, investment properties in Philadelphia. Do you have anybody? And I'd go, well, yeah, I did, but I don't think I wrote his name and number down. So this is another way for us to be able to track what you're looking for. So if you're looking for something specific, if you let us know what that is, we may not have it for you tomorrow or even next month, but if we do come across something that fits your criteria, we'll know who you are and what you're looking for, so we can find the best deal for you. So it doesn't, by the way, I was asked on the last one, no, it doesn't cost anything for that. We're not charging anybody to sign up on our website and tell us what they're looking for. We get paid fees from the sellers when somebody buys something, so it doesn't cost anything. So there's the website. I'd love you to go to that website, let us know what you're looking for. So what you basically just saw was you basically just saw an outline of how an individual investor can buy like a hedge fund guy buys. That's all I was trying to accomplish today. I hope I did that in some form or fashion. The idea was to say to you, you know what, as an individual investor, I believe that your best course of direction for 2014 and beyond is going to be to get the best deal in the best market that's appreciating, married up with the best property management teams in the country, and that's the way you'll capitalize in the market. Again, that model is not new or novel. That is the same exact model that the hedge fund guys use. And so I thank all those folks for educating me on how that model works so that I could then educate all you. So with that, that's my presentation today. I want to thank you all for being here. And again, I apologize for being tardy and forgetting what time my own webinar was. So I apologize for that. I will take your questions now. If you see down below the bottom towards the right of your screen, you'll see a little button there on your dashboard that says questions. If you just click on that, a little box will pop up. And I will answer your questions for you. And just I'm going to hit my mute button for a second where I pull up my screen, and I'll start answering some of your questions for you. Okay. The first question I have is it's a two-part question. The first part of the question is what type of rehab needs to be completed on each of these homes? The answer is, I'm doing some inventory here in my head real quick. Everything I put up on the screen today was finished. There was nothing up there that was not finished. The second part of your question is how do I confirm that the work was done properly and is up to par? The answer to that question is really pretty simple. You get an inspector. You don't buy something that isn't inspected. And what I typically tell people to do is just have the seller pay for the inspector. You know, put the inspector on it's usually $300 to $400. It's not a huge expense. But ask the seller to do the inspection and you know, send you an inspection report. Now I get asked this question a lot, and so people have asked me, well, what if the inspector's out having a beer with the guy that's selling the house? I mean, how do you know it? Inspectors are licensed people. They have a license. They can't give you an inspection report and fudge it just because they want to go have a beer with the guy that just doesn't happen. You just get an inspection report. There's two ways you can buy property. I'm actually dealing with a woman right now in Israel, of all places, has an investment group in Israel, and I'm working with her. And she has decided to go the route of doing the rehab work herself. Just find me off-market properties, not rehab, not rented, just vacant. Find me great deals, and I'll get my guys to do it. I'm not going to oppose that model, but I would tell all of you as individual investors that your best strategy is always to be buy that house rehabbed. Get whoever you're buying it from. If it's not completely rehabbed, it should be their responsibility to rehab it. But in a perfect world, you're better to buy it when it's done. You can see the pictures. It's finished. You got photos of it. You get an inspector report on it. You know what you're buying. I understand the trepidation with some people about buying out of state. I get that. But you want to look at this market as it's an investment. If you're looking at the stock market, you don't look at the stocks and go, I'm going to buy that stock because that company is near my house. The same thing applies to investment real estate. You don't care where it's at. You care that it's turning cash flow for you. Which cities have you been able to buy in yourself? That's an interesting question. There's a lot of different places where a number of us as a team has spent time in buying and doing some flipping. The primary market for the last couple of years has been Birmingham. Birmingham's been a market that, you know, there's probably more happening for the group that I've been affiliated with the most for the last number of years than any other market. Now, I will tell you that Birmingham, the life cycle in Birmingham now in terms of buying, not in terms of the appreciation or the value going up, but in terms of buying, I believe that Birmingham is probably a place that's got about 24 to 36 months. And I say that because all the hedge funds are down there now. They're buying up stuff faster than I can find it. But there's a lot of other great markets for that too. And then really you're talking about a flip when you're talking about this here. And primarily people like myself, we get access to things that are primarily meant to be flipped because they come right from a wholesaler. And the strategy in most cases is just to get in and get out. There's a lot of groups right now, if you didn't know this, there's a lot of groups right now that will finance you to do a flip. Matter of fact, I didn't mention this, but Blackstone's actually one of them. Blackstone is a group that will actually finance you now if you are looking to, you know, be a long-term buy and hold type person, investor. they will finance you to buy that investment property if you've got decent credit and all those sorts of things. So there's a number of different markets, but Birmingham has really been our primary focus really for the last couple of years. Okay, can you still buy using a 401? I get asked this question all the time. Buying directly from a wholesaler has no bearing at all with regards to how you do the purchase. In other words, if you are a cash buyer, you're a cash buyer. It still all goes to escrow. If you're a 401k buyer or a self-directed IRA buyer, or one we had this morning who's buying through her LLC, there's no difference with regards to how that's structured with regards to the acquisition itself. It's all a standard escrow, and I should have probably explained that. If for those of you that aren't aware of how you buy investment real estate, it is exactly the same process as buying your house next door. The only difference is that it's very quick. It's not a 90-day. You don't have 90-day escrows in investment real estate. You don't have 30-day escrows in investment real estate. I mentioned a few minutes ago that I had offers today from a hedge fund. Let me tell you their closing date. Their closing dates are 12 days after inspection. So this is what they do. They make an offer on it, and the same process you could possibly use. You'd say, okay, I want to buy that house, $46,000 is the deal, let's get it inspected. 12 days or 10 days from the time of inspection, that wholesaler would want to close. If you say, okay, we're going to inspect it and I'll close it within 60 days, they will never hold that property for 60 days. That will never happen in a million years. No one will hold a property more really than 30 days. So the closing process is shorter, but the escrow process is exactly the same. It goes to an escrow agent. Okay, how much experience do you have with property managers in these various markets? How do you confirm that they provide a good quality of service to out-of-state investors? Real simple, because I got a whole bunch of clients that have bought from these folks. If you want names and phone numbers of people that have already bought and had experience with property management teams, I'm absolutely happy to give them to you, because here's the deal. This is what I tell them, and I'm just going to say this kindly, but I'll say exactly what I say to a property management team. I'll say, I'm going to give you some properties for some people who bought in your market. If you take really good care of them, you're going to get more. If you don't take really good care of them, you're not only going to get none, but you're not going to keep the ones that you have. Because what the most important thing is for the people that buy out of state is that property management team. Now, I'll tell you flat out who the two of the ones I'd like the best in Birmingham. I don't mind, again, sharing this. There's a group called Decus. The owner's name is Jay Benoit. And there's another group, Property Management, and they're owned by a guy named Payne Baker. I use both of those groups in Birmingham. They are both awesome. They're both great to work with. They take good care of the clients. I had a repeat buyer today who bought a property from us. I think we closed December 15th or something. She bought another one from us this morning, or through us, not from us, I should say, but through us this morning. She bought directly from the wholesaler in the Birmingham market. She has been with Access Property Management. She's happy. She's got her checks 2 months in a row. She talks with the gal down there occasionally to make sure there's no issues with the property. So how do you confirm it? It's real simple. If I say, Nathan, here's a great property. It's in Birmingham, and here's Jay Benoit with Decus, and he's going to take care of you from a property. If he doesn't get taken care of, Nathan's calling me on the phone saying, hey, Charlie, I can't get this guy on the phone, or I can't find out about the tree that needs to be cut in the front yard, or I get those calls. And then when I get those calls, I go back to the property manager and say, hey, I'm doing 3 more webinars this week, and more people are going to buy in your market, and your business is going to continue to grow, but you have to take care of the people we refer to you. So that is a great question, but the answer is really fundamental. If a property manager doesn't perform, they don't get more business, and their business doesn't grow. Go ahead. Okay, next question. Make sure I turn my mute button back on. Okay, if I have a house that I want to sell, what do you charge to put that on your website? Nothing. We're not going to charge anything for that. That's if you want to profile a property, we're happy to profile it for you. Okay, the next question really dovetails in with RO's question, and that is, since there's no middleman, where do I go if there's a problem? I think I already answered that. You go to the property management team, but that doesn't mean that I'm not going to be here if for some reason you can't get response. but the likelihood of that really is super slim. I mean, don't forget something. Property management groups love investment real estate. Why? Because when they get a client, okay, let's back up. Let's look at this from 30,000 feet. Historically, property management companies grew a number of different ways, but primarily it was small investors, and there really weren't a lot of those small investors. I mean, there's always been small investors in the real estate market, but nothing like today. Today you have, if you're a real estate property management owner, think of what's happened to your business in the last 5 years. Think about how many rentals you've picked up, renting properties and taking care of properties for out-of-state investors. I mean, your business is quadrupled, if not more. And so you go to the property management team, but that doesn't mean that I don't, and I do, I'm not going to mislead you. I get calls occasionally from people saying, you know, I got a question about my statement, or I got a question. I'll be glad to help them do that. But really, we've narrowed it down in the markets that we're in. We've narrowed it down to, you know, really just one or two groups. For example, in the Atlanta market, it's Summit Assets Group, and they use Johnny Hamilton, who's also our wholesaler down there. So it's all kind of, I don't want to say it's inbred, but it is. We all work together, and so when something gets sold, there's somebody there that we know that knows how to take care of that property. Okay, from a industry professional, the next question is, do you pay referral fees? I love that question. So in other words, yeah, if you want to refer somebody to us, yeah, we will certainly absolutely pay a referral fee for that. I mean, that's any wholesaler that's out there. If I call them up and say, hey, I got a buyer for you, but it was brought to me by somebody on my webinar who had a contact with a friend looking to buy, and he'd like to get a point or something for making the referral, they will always do that. There's nothing wrong with them paying you a referral fee to send them a name of a potential buyer. Okay, I love this question, and this is the last question I see in the queue. This might be the last one. I'll hang around for a few minutes, leave my number up here on the screen. How do you make sure the properties are of high quality using different wholesalers? It's real simple. You know, you got to vet them out, and there's a number of ways you go about vetting out wholesalers. I had one just a little while ago, so this one's actually, I had a guy that wanted to, you know, specialist properties in the webinar, and he gave me a couple properties. It's a true story. He gave me these properties to look at. I checked with one institutional buyer if they knew who this particular wholesaler was, and within 30 minutes I got an email back saying I've already put these contracts under, or I put these homes under contract. So this has become sort of a small world. You learn pretty quickly who you can work with and who provides a good product and who doesn't. And interestingly, and this is not the guys that provide the guys that provide the best products get all kinds of repeat business, obviously. If they're providing a good product, they're going to get multiple sales, you know, every week, because people know. I mean, if you were to call me up and say, I'm interested in this property, tell me somebody else who's done business with this group. I can give you a number of people who have done business with that group, and you'll be pleased. So that's the last question in the queue. I'll leave my information up here for a few more minutes. If you got any more questions, I'll hang here for a second. People will sometimes email their questions in late. I've left my phone number, my email address up here for a reason. If you'd like to call me, you're more than welcome to do that. Again, I got to apologize one more time for the scheduling foul-up today. And thank you all for being here on such short notice. And again, if you've got questions, give me a shout. We'll do 2 more or maybe 4 more of these next week. I should mention, as I'm waiting to see if any other questions pop up, that I do have a webinar coming up. It'll be week after next now with a group called Meridian. They are a group that provides financing. They're only in one market, which is Memphis, Tennessee, but Memphis, Tennessee is a great market. But they do provide financing. And so if you're interested in looking at a financing piece, and this is one of the few webinars I was not asked about financing, but they do provide financing. They got to have good credit. You can buy through your 401k and self-directed IRA, but it is credit dependent. But if you're looking for financing, be on the lookout for an invite to a webinar with Meridian, and that'll be coming up in about 2 weeks. So with that, I want to thank everyone for being on today. Enjoyed it. Hope you learned something from it. And if you got questions, again, feel free to call me or drop me a note. Be glad to talk to you. And again, I want to thank everyone for being on today, and I still don't see any questions, so I'm going to log off. Appreciate your presence here today. We'll hope to talk to you soon.